Good afternoon, Rotarians and guests. Welcome to the Rotary Club of Toledo. Today we'll present another great meeting and program with Bob Bradshaw. But before we get to that, I'd like to open our meeting with a reflection from Chuck Mann, and then Jeff Stegeman will lead us in the pledge.
There comes a time in your life when you walk away from all the drama and the people who create it. You surround yourself with people who make you laugh. You forget the bad and focus on the good. You love the people who treat you right and pray for the ones who don't. Falling down is a part of life. Getting back up is living. Life is too short to be anything but happy. The words of Jose Harris. Dear God, prayer is powerful and can change the condition of our hearts. May your guidance and wisdom give us the direction and strengthen our resolve to love the people who treat us right and pray for those who don't. Amen.
To the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you, Chuck and Jeff. As we begin our meeting, I'd like to thank and acknowledge this month's sponsor, Rudolph Libby Group. We thank them for their sponsorship and commitment to Rotary. Greeter Ford Bennett will now introduce today's visiting Rotarians.
Good morning, sir. President Dick, we have two visiting Rotarians today. Visiting Rotarians, please stand as I read your name and remain standing until President Dick welcomes you. First, we have Judy Summers. Her home club is from Norwalk and from IPP. Second, we have Sharon Trapick. She's from Maumee and accounting. Thank you.
Welcome, both of you, today. We hope you enjoy the program. Does anyone have any guests they would like to introduce? If so, please come to the floor mic to introduce them.
President Dick, fellow Rotarians, I'd like to introduce a very dear friend of mine who I've known for over 35 years or so, Teresa Morris. She's a congressional staff assistant with Congresswoman Capter's office, and she also handles immigration.
Welcome.
President Dick, I'd like to introduce Kevin Hofer. He is the new head of school at Emmanuel Christian, and he was a very active Rotarian in Pennsylvania.
Welcome. Glad to have you here in Toledo.
Yes, President Dick. With me today is Alex Youngquist, my nephew, who lives in San Francisco, and he raises money for venture capital firms.
Great to have you here.
President Dick, my guest today is Paul Hokenettle. Paul owns 419 Rentals. He's in investment in real estate properties in the Northwest Ohio area. Paul Hokenettle.
Wonderful. Welcome, Paul.
President Dick, my guest today is Louis Tion, who's the president of the Rotaract Group at University of Toledo, and he's a dynamic young future member of Rotary and leader of Rotaract.
Great to have you. We'll be hearing from you later, I'm sure. Thank you.
Would you mind... So the Rotaract Club of Toledo is going to be having a collaborative service project with the Relay for Life Cancer Foundation. We're actually going to be helping to sponsor this event and hopefully take it to new heights that it's never once reached before. If you're interested in learning more, if you could come see me at the end of the presentation today, I'll be in the back and I'd be glad to answer some questions for you. Thank you.
Thank you. Thank you all for attending today. We always welcome guests. Now would be a great time to check into social media. And then I urge you to turn off your cell phones for the remainder of the program and enjoy the gift of Rotary. One of the things I want to do this year is provide some education about the different things that Rotary does. Today I want to speak at the four-way speech contest, and we have a special guest in that regard. The four-way speech contest is an annual project for students in grades 9 through 12 to bring the Rotary four-way test to life in a 5 to 7 minute speech. Clubs hold local speech contests, and the local winners move on to represent each participating club at a district-wide competition. Our club's Vocational Service Committee sponsors our local speech participants. This year, our Vocational Service Committee will be chaired by Kurt Church, and Greg Guzman will serve as vice chair. I'd like to have our Vocational Service Committee members from last year and this year please stand to be recognized. There must be some of you here. Thank you very much. And I know we'll be hearing more about the Vocational Service Committee throughout the year. We are very fortunate today to have the 2017-2018 District 6600 four-way speech contest winner, Anna Little, with us today to present her speech. Anna will be a senior at Norwalk High School this fall. She has been doing speeches since the 8th grade, when she did a speech for a Fraternal Order of Eagles contest called God, Flag, and Country and did very well. Many of us heard Anna speak at this past district conference in the spring, and I know you will be impressed. So today I am very happy to introduce Anna Little.
Thank you. Last summer, I went on a mission trip to Malawi, Africa, one of the poorest countries in the world. While I was there, I got to see the old well, which was a hole in the ground filled with muddy water, and I also got to mud a hut. I then spent 4 days with over 100 young people playing games and learning from each other about Christian love and leadership. We were able to connect with one another despite the communication barrier, and we all learned that laughter is the same in every language. As I plan on continuing my relationship with the project in Malawi on future mission trips, I have educated myself greatly on its culture. It is important never to ignore the culture of the host country, but instead let the mission be guided by the needs of those we seek to serve. In Malawi, we are improving the lives of young people through educational opportunities, nutritional food sources, and increased sanitary conditions and personal hygiene. The four-way test can be used to make sure a mission is done for the right reasons. I will show you how you can use these lessons to guide your own projects. Using my mission trip as an example, let us first examine culture shock. This comes along with the first aspect of the four-way test. Is it the truth? As you make your way to the country, you must learn about what you are going to see. Especially when the country is very distant, the customs and language will be very different from what you know in America. If you have not mentally prepared yourself for what you will witness, you may experience culture shock that will isolate you from the people around you and take you away from the moment. Being prepared can allow you to engage more fully with those you will meet. Once we were aware of the whole truth of the situation, meaning we knew what the focus of our mission was to be, we were ready to take action. Alongside these Christian teenagers, we discussed our similarities and our differences, inspiring one another to see that each of us can make a difference in the world around us. In order to promote fairness, the second aspect of the test, we spent our time with mixed gender groups. Boys and girls are often separated in public spaces as part of the Malawian culture, but it's central to our mission to give them the tools to work together as adults for a better Malawi. In our Christian mindset, God made us all equal, and we wanted to affirm that equality through every aspect of our mission. Missions work best through long-term relationships. While a tourist may make friendships, they may never return to the country again. The bond we have with our hosts and with the teenagers from the village goes so much deeper. For this reason, the third principle of the test is honored, as we promoted goodwill through the work we did, but we also deepened our friendships. We commit ourselves to return and to continue working together for the well-being of our friends. Not only did we spend time at the project together, but we also bonded over meals and spent time with people in their homes. More importantly than any one moment we spent together was the overarching purpose of the mission. Malawi has one of the highest child marriage rates in the world, which puts young girls at a higher risk of contracting the AIDS virus. It's undeniable that educating these teenagers on traditionally taboo subjects such as unprotected sex and even the basics of menstruation was helpful. We were only able to discuss such delicate subjects because of our long-term commitment and trust of one another. One mistake that some tourists make is to assume superiority. The truth is that while we think we may know best, those we seek to serve know what they need most. It's more important to listen and learn than it is to give advice. Help should be offered upon request only and then given without judgment. This is when the most influential work will be done, as cooperation builds stronger relationships. A mission has failed if it cannot build up the community to stand on its own. The saying goes, give a man a fish and you feed him for a day. Teach a man to fish and you feed him for a lifetime. This is most certainly true, because when you teach a person how to solve the problem in a more efficient way, they can continue to solve the problem even when you are not there. Dependency leads to something less like friendship and more like parenting. Real love is more balanced because we are working side by side for a common goal. I hope that my mission trip has been a good example of use of the four-way test, but there is still more work to be done. Even if you do not go on a mission trip, there are ways that you can use these principles for daily diplomacy and cultivating meaningful friendships. You can offer help to those around you in the same way you offer to those abroad, without judgment. When we let our judgment take control, we evaluate whether or not people are worthy of our help. We are obligated as good Samaritans to help without boundaries. You can teach others to be self-sufficient rather than encouraging dependency through mentorship rather than donorship. Donations, though virtuous, can take away a meaningful learning experience. Finally, through mentorship, you can foster a relationship of equality where you both learn from each other. This comes through showing genuine love and a caring attitude, and a partnership cannot thrive without these. The four-way test is valuable, not only in large-scale projects, but in everyday life, from helping a neighbor in need to mission trips across oceans and continents. By being truthful with ourselves, we can make sure we are serving for the right reasons. By showing fairness, we respect the dignity of all persons involved. By treating other people as equals, we can work together and build more meaningful friendships. And finally, by listening to the express needs, we can make sure we are making the best of every minute of our time and every ounce of our resources. Thank you.
Thank you, Anna. We wish you a great senior year and much success beyond. We thank you for sharing with us today. This time I'd like to invite Rotarian Brent Kuzno to the podium to introduce new member Daniel Woodcock.
Thank you, President Dick. And Anna, that was great. It's a hard act to follow, but we will be looking for you in Rotary in the future. I'm co-chair of our Membership Development Committee. We'd love to talk to you at the right time. Good morning, or good afternoon, I should say. President Dick, fellow Rotarians, it's my pleasure to introduce Danny Woodcock. Danny was born and raised in Chardon, Ohio, and he attended the University of Toledo, where he graduated with a degree in marketing and business administration. Previously, working at local ad agencies Hanson Inc. and Communique, Danny started his own social media marketing company in 2015 and now serves clients all around Toledo, including Metro Parks Toledo, the Toledo Symphony Orchestra, the Epilepsy Center of Northwest Ohio, and the University of Toledo Launchpad Incubation, among others. After discovering a passion for the city and seeing the opportunity in downtown's revitalization, Danny relocated to downtown Toledo in 2015. Danny's a co-founder of Toledo Matters Media and a co-host of Toledo Matters podcast, which I haven't listened to yet, but I'm going to. It's a podcast about Toledo movers and shakers that are impacting our local culture and businesses. Danny serves as secretary of Downtown 419, and many of you may remember several weeks ago on at a very hot meeting like today with no air conditioning, we introduced Jeff Stegeman and Mike Abernathy, and they are also part of Downtown 419, something we might want to tune into a little bit more. The mission of that not-for-profit is to promote social and economic vibrancy in downtown Toledo. He's also serving on the Charter Board of Trustees and EPIC Toledo Advisory Council. So, fellow Rotarians, please join me in a very warm welcome for Danny Woodcock. And as long as I'm here, I have to make a couple comments about membership, right? So, after last meeting and the great news that we were number 9 in the world, moving up from number 11 as a club in the ranking of 33,000 clubs, I had to find out, what is number 8? How many people do they have? Well, Emily told me today, this morning, 475. How many do we have? As of June 30, 447. If we repeat our performance of last year, we'll be there, and our goals are set higher than that. So let's go for number 8, and thank you all.
Keeping with that theme, I'd like to invite Mark Arrudia up to the podium to introduce new member Michelle McCaster.
Yes, President Dick, fellow Rotarians, I'd like to introduce and give a warm welcome to one of our newest members, Michelle McCaster, into Rotary. She was born and raised in Toledo and went to Rogers High School here in Toledo. She graduated from the University of Toledo as well with a degree in nursing and psychology, and is currently a nurse anesthetist and is working as an independent contractor for ProMedica and AmSurg Anesthesia Services. Ms. McCaster is the founder and CEO of Groomed for Greatness, an empowerment nonprofit organization for girls ages 14 to 17 that strives to help girls reach their professional and personal goals. Michelle is a member of the Association of Nurse Anesthetists, Diversity in Nurse Anesthesia Mentorship Program, Toledo Toastmasters, the Toledo Alumni Chapter of Delta Sigma Theta Sorority Incorporated, and the University of Toledo Alumni Association, as am I. Michelle enjoys working with youth and giving back to her community. She has a scholarship fund in honor of her mother to provide scholarships to individuals seeking degrees in nursing and health-related fields. Michelle enjoys traveling, is a foodie, and loves learning about different cultures. She is the guardian of her cousin, Miracle, who is 11 years old. Michelle is excited about becoming a Rotarian and looks forward to working on service and fundraising projects. As a matter of fact, she's already signed up for a couple committees already. So please help me welcome our newest member, Michelle McCaster.
Thank you, Mike. Well, at this time, I'd like to invite Rotarian Bob Gardner to the podium to introduce our presenter, Bob Bradshaw.
Thank you, President Richard, and fellow Rotarians and guests. It's my pleasure to introduce today's speaker. Bob Bradshaw, CPA, is a partner in the tax department of William Vaughan Company. He offers comprehensive tax planning services as well as consulting and compliance service to middle market clients, including entity selection and reorganizations. He also specializes in business of all sizes with planning and compliance in connection with SALT, or state and local taxes. He works in connection with planning and compliance requirements and reporting Bob is a leader in the firm's service line for manufacturing clients. A graduate of Adrian College with a Bachelor of Science in Accounting, Bob is a member of the American Institute of CPAs, the Ohio Society of CPAs, and he currently serves as treasurer of Nature's Nursery in Whitehouse, Ohio. Bob lives with his wife and 3 children in Sylvania, Ohio. He's going to give us a talk today about the impact of the Tax Act of 2017. Please welcome Bob.
Thank you, Bob, and thank you to everyone who came out to listen to me chat. I'm sure as you'll gain from me talking, I love talking tax law and everything about it, and any chance that I have an opportunity to come out and do it, I absolutely love doing it because I'm no longer allowed to do it at my house. My wife told me my 4-year-old daughter doesn't care about 199A. Who knew? Okay, so why are we here today? Back in November 2nd of 2017, the House put out a bill for tax reform. That bill got signed into tax law on December 22nd. So under 2 months, we went from a bill being introduced to an actual signed into tax law. Give some perspective on that. The ACA Act that passed back in about 2012, that took over 2 years to draft, and we're still changing that now. The whole reason I bring that up is everything I'm going to tell you is likely going to change. So thanks for coming out. No, the reason we bring it up is that these laws that we're going to be seeing are going to continue to change as we're going through there. The reason why it passed so fast is what's called the Reconciliation Act. What that means is it's a simple majority, 51 votes in the Senate. We can get it signed into law if the bill reconciles after 10 years. They approved a $1.5 trillion cut in our tax law. So a lot of the code and a lot of the things we'll chat about today, some are actually beneficial, most are actually beneficial, but there are some things that are actually tax revenue raisers, and the reason was to make that $1.5 trillion cut. Most individual tax cuts that we received are all temporary, meaning they will sunset or expire in 2025. So 2026, we go back to the laws that we had just back last year in 2017. All business ones, or almost every single business one that we'll see and we'll chat about, are permanent. So it would actually have to take an act of Congress again to change that. They did that for a main reason is everyone should be filing an individual income tax return. If you're not, see me afterwards. We have a bunch of different issues than what I'm going to talk about today. But besides that, it's more likely that will continue after 2025. It's easier talking points than what we're going to be seeing on the business side. So without further ado, we can jump right into the slides. Overview, again, talking to individuals first, most important, everyone does that. C corporation changes, this is the reason why we got tax reform. We were not competitive on a global market, and so they came in and we redid our C corporation changes. Next, we'll dive into business pass-through deductions, the 199A. This is probably the most hotly tested thing within the CPA environment in the world right now because there's a lot of ambiguity within this, and we need to get some more clarifications. We're hoping some regs come out, but again, who knows? Then we'll dive into some other things. So what most everyone cares about is where do I fall out? So as you can see from this slide, this is married. The next slide is single. But as you can see, every single person is going to see a reduction in their taxes from next year. Keep in mind that this has to do with your wage and everything else. In February of this year, the Congress or the IRS actually put out the new withholding tables. So your wage has already seen that change within your withholding. So you're actually getting a little bit more back. They estimated somewhere around $100 to $200, depending on where you're at. But you're seeing that in your take-home wage if you're a statutory W-2 employee. So you're not going to see that big refund come April 15th of next year. You're actually seeing that now. So that's just one thing to keep in mind as you're going through everything. But one thing I did want to point out is the marriage penalty, it's back, and it's back with vengeance, as I like to say. If you look at this chart here, I know there's a lot of numbers, but if we just jump down to that bottom tax line, it's 37%. If you're single and you make $500,000, you're actually in the 35% tax bracket. The second you get married and your wife also who's making, or your spouse making $500,000, it kicks in at $600,000. So $400,000 is being taxed at that new 37%. But again, if you're having that impact, not that big of a deal because, again, we have bigger issues to worry about than that 2% if you're making $1 million. Another thing to point out, these capital gain rates, a lot of us are familiar with that. That's the tax on your dividends and your capital gains. Those did not change. Those used to be linked to the top tax bracket. So when you were in 2017, if you were in the 39.6%, that's where your bracket was at. They didn't adjust those. So you are going to be subject to the 20% as soon as you hit about 478, 479. In addition, we didn't repeal the 3.8% NII tax, or the NIT for short. That is still out there. The 0.09% on your wages, your Medicare wages, that is still there. They didn't do anything for that on the ACA side. I just wanted to point that out because that's a big talking point for a lot of people. So what did they do? Well, they doubled the standard deduction, basically. You went from $12,700 to $24,000 if you're married, filing joint. The singles kind of are all the same. So this is what you probably heard a lot about, is most people, they estimate somewhere around 93% of us will be itemized or claiming the standard deduction in 2018. That's up from about 73% in 2017. The way they've done it is, one, they've doubled that, and then we'll get into some of the other things they've limited in the thing. Another key aspect, what they did, way to balance that budget, was they removed personal exemptions. Every single one of us got a $4,000 deduction for ourselves, $4,000 for our spouses, $4,000 per kid. We no longer get that deduction at all. It's completely repealed. So the way they helped fix that with the kid, or with children, is this child tax credit. Most of us are familiar that if you have a kid 17 or under 17, you get a $1,000 tax credit. They jumped that to $2,000. The way the math works behind that is if you were in a 25% tax bracket before, you got a $4,000 deduction for them, equated out to $1,000 in tax savings. They tried to mirror that here. Two big things that they did, and credit Rubio for this, is that they increased the refundable portion, meaning that $1,400 of it is now refundable versus the first $1,000. In addition, they increased the phase-out limits. Before, a working family that made $120,000 would see this credit phase out. They jumped at the $400,000. So that's one of the nice things that a lot of people who had two working spouses weren't able to claim this credit are now going to be able to see going forward. So what is an itemized deduction, and are you going to be able to itemize? Most likely not. The main reason is this one right here, which was the most hotly contested item come December 22nd. The reason is they capped our SALT deduction, our state and local income tax deduction, to $10,000, which includes your real estate tax, plus any income tax or sales tax, the greater of those two. We live in Northwest Ohio with city tax and sales, so obviously most of us are going to hit the income tax portion of that. But that's capped at $10,000. So it doesn't matter if you paid $15,000 or $20,000, it's still going to be $10,000 limitation. Now, what a lot of us did at the end of the year in 2017 was scramble around to prepay all our real estate taxes. We may advise our clients to, hey, if you're not going to get this and maybe pay 2, 3, 4 years, whatever cash flow allows. Well, on December 28th, they came out and said, no, you can't do that. You can only prepay 1 year, and it has to be attributable to 2017 taxes. So there was a little bit of that going around. It was nice of them to wait until December 28th because I didn't want to have a holiday. Jumping in, some other things that they limited is the mortgage interest. They've dropped that from $1 million to $750,000. Most people don't want to feel that. But what they did was they've repealed the home equity deduction if it's not for the purpose of improving your house. So if you had that and you purchased a vehicle through your home equity line and we're getting the tax benefits for that interest, you're no longer going to be claiming that. So that is one thing that they did to try to increase that revenue point. Another thing that they also did is they repealed 2% miscellaneous deductions. Basically what 2% is anything that you spend out of your pocket that isn't a business expense that was generated to or used to generate revenue. What is that? Unreimbursed employee expenses, your mileage, stuff like that. Tax prep fees, those are no longer deductible. Investment fees, those are no longer deductible. So we got to come up with creative ways with brokers to rearrange and how we're doing things with those to become deductible. But those are just so you know, those are no longer going to be deductible starting next year, or I guess this year. Medical deductions. That was actually a nice thing. What they did was prior to 2017, it was 10% of your adjusted gross income. They changed that to 7.5% for a two-year stint. So any deduction that we get will be limited to 7.5% of your AGI. They also bumped the charitable contribution limitation. For those of you who do this, I don't know anyone, but if you want to give away 50% of your income, you can now give away 60%. Personal casualty losses. This is actually kind of a big thing for a lot of us. Most of us don't have personal casualty losses, but now they have to be a naturally declared disaster, meaning that if you have a fire in your house and insurance doesn't reimburse you enough, you can't deduct that anymore. We used to be able to get that in 17. We no longer get that in 18. However, the wildfires out in California, obviously that's a nationally declared, so they will be able to deduct those losses that are, again, in excess of AGI. They repealed what's called the P's limitation. The reason they repealed it is they've limited everything else, and there are very few of us who actually work through that calculation. But it's just a way to limit the limitations on wealthy. Some other key things to be known: alimony. So any divorce decree after the end of this year, you will no longer be able to deduct alimony. The reason why they did that is it's called the alimony gap. There are estimated $320 billion worth of deductions that were claimed in prior years that were not being reported as income on the other side. So they said, hey, we're enough with that. We're going to close this gap and do it. They tried to get it passed in 2017, right at the very end, but my guess is there's a few congressmen who saw the writing on the wall and asked for another year. Repeal of moving expenses. This is just another thing that they repealed. Just be aware of that before we are allowed to deduct them. You can no longer deduct them going forward. This is an interesting one. Gambling losses. They expanded the definition to now include the travel to and from the casino as a gambling loss. I don't know what you guys were doing with your gambling losses before, but just so you know, it's part of it now. And you can only deduct gambling losses up to gambling winnings, which stays the same, which ironically is actually going to hurt a lot of people because this is as an itemizable deduction, so you have to itemize to be able to claim it as well. So one nice thing that they did was the 529 plans. You can now withdraw and spend $10,000 per year per kid on K through 12 private schoolings. So Ohio allows a $4,000 deduction right now. They haven't came out and said they're going to change that up yet. But they could. But basically, you can contribute to a 529, pull it back out, and then pay for private schooling here. And then, obviously, the discharge of student loan debt, that's just a no-brainer. That should have been done a while ago. Recharacterization of Ross. Basically, what this says is if you had an IRA and you recharacterized it as a Roth or you converted it over to a Roth, you had up until the extended due date of the tax return to roll it back if the market went down. So if you rolled 12/31 to 10/15, the market was down from when you rolled it, you could undo that, re-roll it, and not suffer the consequences, the downturn in the market. They said, no, we're not going to allow that anymore. As soon as you do it, it is automatic and permanent. The one key fact about that is anyone who did that for 17 can still wait until October 15th to re-roll that back if they want to do that. AMT. AMT is pretty much dead. I think a lot of us are going to rejoice in knowing that. There are only two types of people that are going to be hit with AMT, those who have what's called incentive stock options and those that have business property that's being depreciated much differently for AMT purposes than tax purposes, but mainly it's going to be those incentive stock options. The reason why AMT is dead is the things that were added back for AMT. For those who aren't familiar with AMT, it's that heads they win, tails you lose scenario where the IRS makes you calculate it two different ways, and whichever one's the higher, you pay the higher tax. A lot of the preferential items for AMTs, what we call them, are your taxes, your 2% miscellaneous item deductions, your home equity loans. If you remember a few slides back, they've repealed those or limited those, so we're no longer going to have those huge add-backs for AMT. They've also increased the phase-out limits and such, so that the fact is you're not going to be really hit with AMT going forward, which a lot of us are finally happy with, because AMT was established in the 1960s. What we know it as of now is 1983, and basically it's meant to be a tax on wealthy, but it was never adjusted for inflation. So it's always hitting the middle class people, the wrong set of people that it was meant for. So that's kind of nice, and a lot of us are actually happy about that. Some other miscellaneous things to know about. The Affordable Care Act penalty is reduced to 0, so starting next year you don't have to carry it if you don't want to. It's interesting, they reduced it to 0, they didn't repeal it. Carried interest, we don't have much to do with that, but it's 3-year window versus 1. And this is the one I'm finally happy they got out of there, was this bicycle commuting reimbursement. Get this, apparently employers were allowed to reimburse their employees $20 per month, and it was excluded from wage. They scratched that from the law. Now it's includable. So what that means is basically, if you think about the people that were including this $20 in their wage, or the areas that they were doing that, were New York, California, New Jersey, places where it's high bicycle commuting areas, or the ones that didn't vote GOP come. So it's always interesting to see the politics kind of leak into the tax reform. Some unchanged provisions. This is what we saw in November that didn't make it into the Senate bill or didn't make it into the final bill that was signed into law. Basically, your principal residence is still the exactly same, 2 years, 5 years. So you got to live there 2 years. Past 5, you could exclude up to $500,000 if you're married. Teaching expense, student loan interest, dependent care, those are all still there. Estate tax, gift tax, I always like to say dying got a little bit better. Mainly because they jumped the exemptions. So now it was $5 million, now it's $11 million or so. If single, married, it's $22 million. But what's important about this is, one, it sunsets in 2025. So I don't call it out on too many things, but this is important to know, because 2025, we actually go back to the old $5 million thresholds. So it's still important that we're talking about and thinking about estate planning. It's one of the biggest areas that everyone focuses on. Estate tax has been repealed 5 times over its existence. And it's easy talking points for everyone in the politics, because call it a death tax or call it a tax on the wealthy, and it gets the attentions of the headlines. So it's easy to focus in on and look at. So just continue to, even if the 11 million, you're like, hey, I only got 5, continue to think about what's going to happen in the future as we continue to go down the road, because all I can tell you today is I know that your assets will appreciate in value. In 2025, it's going to be a lot bigger number than it was today, so we don't want to know what we could have gifted. Continue to work on those plans today. All right. Now the whole reason for tax reform. As I mentioned, this is the main point. This was a topic of every debate, and it dropped the corporate C rate from 35% down to 21%. Now they're even talking about dropping that down to 20% in future years, either this year or next year. We'll see what happens with midterm elections. And obviously they did repeal the AMT for corporations, but that's just because it was at 20% versus 21%, so that just makes the most sense. Some other things to know about this corporate restructure is that there's this new provision called net operating loss limitation, meaning that if you generate a loss in 1 year under the new expensing rules that we'll get to here shortly, you still are going to only be allowed 80% of a deduction in the future years. So you're still going to be paying a little bit of tax, which is different than years in past. So just keep that in mind. They've also reduced the dividends received deductions that you were getting if you own a C Corp. You got a little bit of a deduction. So the biggest topic that has flaunted most of us CPAs out there is this new 199A. What is 199A? It's a brand new code section. They squeezed it in right after 199, and it applies to all pass-through businesses. So if you think about it, C corporations dropping that 21%. If you own a pass-through, that's got reported on your individual tax rates. We only dropped 2%, 39.6 down to 37%. So we still are paying high income taxes on your business income. So instead of having this big flush back up to C corporation world, they came out with this new tax law that says, hey, we're going to let you exclude 20% of your business income with some limitations. But here's what it really boils down to. If you make $315,000 as a married filing joint, or if you make $157,500 for everyone else, including trust, you will get this deduction. It doesn't matter what line, what service, what you're doing, your wages, your tangible property. It doesn't matter. You are going to get a 20% reduction. It only matters for those of us that are not, I wish I was one of them, above the 315. So if you're above that 315 threshold, then we got to start looking at the rules and the regulations of how they wrote them to see if you're going to qualify for this new deduction. So basically what it says is that any trade or business will qualify. What is a trade or business? No one knows. No one has ever tested this throughout the entire lifetime of Congress. They've talked about it on 162, 212. They never defined what is a trade or business. The reason being is they've never had to. Why is this important? Does your rental real estate that is a triple net lease that basically gets the rent payment into your bank account, then it pays the mortgage automatically, then transfers out into your own personal account, is that a business? Is that a trade or business? We don't know. We're thinking that it does, but we don't know. I would stand up here and say to you, maybe we should be rethinking and restructuring, at least paying the real estate taxes out of your real estate business to think about to make sure that you're qualifying for this new deduction. In addition to this trade or business caveat is if you are in what's called a personal service business, you do not qualify for this deduction. What is personal service? Anything that takes your reputation and you needed to bill for an hour. So think about lawyers, CPAs, myself included, the healthcare. Anyone that has a specific set of skills, those are considered personal service lines, and it starts phasing out at $315,000, meaning you do not get the deduction from $315 up to $415 when it's completely phased out. So again, the CPA firms, the lawyers, we're all thinking about ways to restructure our organizations to qualify at least some exempts. Because again, the law points to trade or business. It doesn't point to separate legal entities. So using a CPA firm, for example, we could have a billing, which doesn't require specific skills to do a tax return as such, but we could have our billing department handle and break them out as a separate line, and that would qualify under the current rules and regulations right now. And then the actual CPA side, the tax service, the accounting, the attestation side, that will not. So that's just one area to continue to think about. We're hoping for some more guidance out there. And again, for those of you that are not in the personal service but above the 315, there's a limitation. And the way that limitation works is it is 20%. It is the lesser of 20% of your business income or the greater of 50% or 25% and 2.5% of your cost of your building. So what that basically means is if you make $1 million, you take 20% of that's $200,000. If you paid wages of $500,000, your limitation would be $250,000. So you would still get that $200,000 deduction in this scenario. If you paid wages of $100,000, it would be capped at $50,000. So again, we need to start rethinking about wages and how those are in there. The other aspect about this is the real estate, as I keep mentioning. This came in at the very last minute. I have to think that someone with a lot of power in real estate who owned S corporations came in at the last minute and said, I want a deduction as well, because what this does is it allows you to deduct 2.5% of your unadjusted basis of your property. So that means you look at the original cost of it and you get to calculate that by 2.5%. So again, there is that calculation that's going to be in there in that limitation. So at this point in time, I think it's always best to run through a quick example of what this is. Now, there's a lot of numbers up here, but basically I just want to boil it down to the bottom line. This example assumes a complete distribution of all proceeds out of the C corporation. Those of you that are familiar, is a C corporation, there's a double layer of tax. You get taxed at the first one, that's at 21%, that's a $210,000 line item there. Then you get taxed at the dividends or the cap gain rates. Remember, I mentioned those earlier on, and that's what that tax is, the $188. Then there's that tax on your wage, assuming you pull a $200,000 owner comp out, and it boils it all down to you're going to get $765,000 after we run through the tax scenario. S Corp, we do the same thing, except that when you're an S Corp, you get taxed on everything as if you distributed it or not. So it doesn't matter if you didn't pull it out, you're still being taxed on it. So that is why, at the end of the day, once we run through the scenarios, you get about $890 because you don't have that double taxation on the dividends. Now, keep in mind that you can look at that wage line item and like, hey, why is that $74,000 versus the $36,000? It's basically because that $800,000 blew through your bracket. So now you're going to tax that 37%. So 37% on 200 is that 74,000. So that's basically it. This assumes a complete distribution of profits. Now, being a CPA and an accountant, I have to know where the break-even point was. On this scenario, it was about 33%. Everyone is a little bit different depending on what numbers you have and what situation you're at. But it doesn't, if you're not distributing that much, or if you're a personal service corp or S Corp, you may think that C Corp could be more beneficial. In addition to this scenario, there's a new code, or there's not a new code section, there's a code section called 1202. 1202 basically says if you sell the C Corp stock and you've always been a C Corp, you can exclude 100% of the gain. So that means before 2011 you couldn't, but after that you can exclude 100% of your gain upon liquidation of the company. You have to sell your stock, though. That is the key aspect of 1202. A lot of us are going to start revisiting this to see if it is actually more beneficial, more likelihood that you could sell it upon the final liquidation is if you can sell stock versus assets, because a code section that was very hardly used before is now becoming ultra attractive for a lot of businesses. Basically, all this means, though, is if you have a business entity, you need to go back and talk to your CPA or whoever to see if it makes the most sense. What your structure is. Because if you're a partnership, you notice that guaranteed payments are not includable for that 20% deduction. So if you make $1 million and all you pay is guaranteed payments, your deduction is going to be zero because you don't meet that 50% of wages. So it's just things to think about. Interesting fact is you can't pay wages out of a partnership to yourself. There's a statute back in '66 that says no, you're not allowed to do that. So we don't know if that was Congress's intent to reward S Corps, but we'll see. Those will come out in the regulations, or at least we're hopeful that they do. Now, other things besides 199A. This is the big key thing that you may have seen the president talking about, is this immediate expensing or capital expensing. For us in the industry, we call it 168K. It's bonus depreciation. You're allowed to expense 100% of assets purchased within a year. No longer does it matter if it's new, used, or anything like that. The interesting thing about this one, it was actually retroactive to September 27th. We got the tax law signed December 22nd, but assets purchased September 28th were now allowed for 100% bonus depreciation. So that was fun for tax planning purposes as well. Phase out starts in 2023 on this one. This is going to be key when I talk about like kinds here in a second. Another thing that they did is they expanded 179 from 500,000. It jumped up to $1 million, and they've expanded this definition to also include roofs, HVACs, fire systems, alarm systems. That's actually really nice because that's 39-year property or 27 and a half, depending on what type of structure it is. We can now immediately get the benefit from that. And I mentioned the like-kind exchanges. They have repealed this for tangible property. So if you buy any type of vehicle is a good example, and you trade your car in, and then you get a new car for that trade-in value, that is a gain at that point in time. The reason why they repealed it was they were like, you are getting the bonus depreciation to immediately expense that to offset that gain. You book up the value of the asset, and then you take it right off. The key thing is this doesn't expire, bonus depreciation does. So in a few years, 2023, when we start phasing it out, we're going to have a matching issue we're going to have to go up against. Some other items to chat about, this interest limitation. If you make over $25 million, this is going to apply to you. Basically, they're going to be capping you on the amount of interest you're allowed to expense. You're no longer allowed to be have a lot of debt on your books. Now, there are exemptions from this, particularly in the real estate areas where you can get an exemption, or you can elect to have this not apply, but then you got to change up how you're depreciating things, mainly under a 15-year depreciation life on most everything. The interest expense is carried forward. A couple other provisions. I know my time's running a little short, and I apologize for cramming this in. But the accounting methods, this is actually kind of a nice one, is that anyone who was under $25 million can now be cash basis. This is huge for people that carry inventory. Before 2018, you had to be on an accrual basis, meaning your accounts receivables, you were paying tax on dollars that you didn't have yet. So now you can elect to be cash basis for if you're under $25 million on average gross receipts, and be able to not pay tax until you get the actual cash in your pockets. So any of you that have a balance sheet and you make under $25 million, just pull it out, look to see, is my accounts receivable bigger than my accounts payable? If it is, you're going to want to switch to a cash basis because you don't want to be paying taxes ahead of times. Again, the average 263A is just a method for calculating inventory. The IRS doesn't think we do it capitalize enough overhead. This was a way to do it. It doesn't apply for $25 million. Another big thing here, especially for Northwest Ohio, construction. If you make under $25 million, you can be under completed contract versus percentage of completion method. So again, another big thing for it, meaning you don't pay tax until the project is 100% complete. I mentioned they repealed 199A or 199. That was a domestic production activity deduction. Basically, that was just a 9% deduction if you manufactured goods here. With a reduction of tax rates, they've repealed that to try to mirror each other. This is one of them that we're going to need some more guidance on, is this 50% of deductions for business-related expenses. So what does that mean? Basically, your tickets to the Mud Hens and stuff like that are no longer going to be deductible. The suites tickets, they're no longer going to be deductible. Are the meals that we have when we go there deductible? I'm not certain. If you're taking a business client there, I don't know. But we're going to have to see what they say out there. If it's primarily for business, I still say do it until they tell us not to do it. But this was one of the areas they closed down to try to make the $1.5 trillion cut. And they felt this was more abused area. So that was one thing. R&D credit, huge for manufacturers. If you're manufacturing, you got an R&D credit on your tax returns, or you could get a manufacturing credit. But the 280C deduction, or the limitation that they had in there, is actually tied to the corporate tax rate. Doesn't matter if you're a business, Schedule C, pass-through, doesn't matter. It was still tied to the corporate tax rates. Because of the change, a 21% change from 35, you're actually going to be seeing more on your R&D side, which is great for business, especially in the manufacturing area. Limitation, I'm going to jump over this one. Basically, you can't deduct more than $500,000 of losses in a year. International, real quick, this was the thing that that caused a lot of headaches on April 15th, or right around there, was this mandatory repatriation. Basically, from 86 to 2017, you had to calculate everything that you had abroad, and then you had to pay tax based on what type of income it was, either at the 15.5% or 8%. But now we've shifted to a territorial type of tax. Basically, you get 100% of, you can exclude 100% of your income that you make overseas, and you bring back if you're a C corporation. So that's one way that they made it so we can become more competitive on a global scale. So I apologize for going really fast. This presentation was written for an hour and a half, so so I just wanted to get through because I want to respect your times. So things to think about, again, entity structure. Make sure, whatever type of entity you are, you're just revisiting that, because the old rule of thumb is throwing a C corp out the window is no longer there. It could be an actual attractive type of business. Cost segregations are more important than ever, with the bonus depreciation being 100%. Continue to look at expensing immediately. Accounting method changes. Again, if you're under that $25 million threshold, cash is the way to go. R&D study is still always going to be there. IC-DIS, for those who don't know, is just basically it's for international sales. If you have somewhere around $500,000 of international sales, you should still be looking at the IC-DIS. It's still beneficial. And then the very last thing I'll point out is for those of us who are itemizing or close to that $24,000 threshold, we need to start thinking about grouping. Basically, you start grouping your charitable contributions at the end of the year or the beginning of the year, depending on how you want to do it. If you're going to make large charitable contributions, the way to do that is what's called a donor advised fund, a DAF. The way to do basically, you give all your money away, you get a deduction now, and then that DAF will continue to make that donation year after year for you at the same threshold, and then you get that deduction now. So that's my time. Obviously, if you have questions, I'll take some now, and if I don't get to them all, I'm happy to. My contact information's here. Please feel free, because again, I love talking this stuff, and I'm not allowed to at home.
somebody wants to ask you after the meeting.
Oh, yeah, absolutely. I'm here all day.
We might have time for one question, and Bob said he'll be available after the meeting if you have any questions. George, could you go to the mic, please, so we can hear your question?
Didn't the politicians tell us that individuals would be able to file on a postcard?
Yes. They did actually come out with a draft, I think about a week and a half ago, and it was about a page and a half. But I just don't ever see that happening.
A quick question. I ran across an article where New York and New Jersey and places like that were trying to pass some sort of bill to allow for state and local taxes to be
Great
deferred, paid a different way somehow, and it seems like that's not really their job.
Yeah, so what they were doing was to come up with a way to make a charitable contribution, because those are not limited, but yet get a one-for-one deduction on your state bill. They've come out, the IRS has issued guidance saying that it's too much of a reduction. There could be somewhere around a 50% reduction of your state bill, but as it sits right now, there were a couple states, as you pointed out, that have overturned this, or the IRS has said, no, we're not going to allow it. I thought it was pretty creative. You get a charitable contribution, and then you don't have to pay state tax, but they've said no to that.
Thanks. Thank you very much. Thanks, Bob, for today's great program. To show our appreciation, the Toledo Rotary Club Foundation will make a donation to the Rotary International Polio Plus Fund in your name. So thanks again. Please join us next week when our speaker will be Tim Menke with Lott Industries. There are no committee meetings scheduled for today. I want to again welcome Daniel and Michelle. It's great to have you both with Rotary. We look forward to your involvement. And thank you, Brent and Mark, for bringing these great people into Rotary. Chuck, you get to go front and center today, man, so here you go.
Wow. Not only did Amazon open for business this day in 1995, but today is the birthday of Lawrence Sanger, the co-founder of Wikipedia. So I did some research last night. According to Wikipedia, this is the funniest joke ever written. Look it up. This is what they say is the funniest joke ever written. Two hunters are out in the woods when one of them collapses. He doesn't seem to be breathing and his eyes are glazed. The other guy whips out his phone and calls 911. He gasps, "My friend is dead. What can I do?" The operator says, "Calm down. I can help. First, let's make sure he's dead." There is a silence, and then a gunshot is heard. The guy runs back to the phone and says, "Okay, now what?" And last, today is also National Snake Day. Again, look it up. An old snake goes to see his doctor. "Doc, I need something for my eyes. I can't see well these days." The doc fixes him up with a pair of glasses and tells him to return in 2 weeks. The snake comes back in 2 weeks and tells the doctor he's very depressed. Doc says, "What's the problem? Didn't the glasses help you?" The snake replies, "The glasses are fine, Doc. I just discovered I've been living with a water hose these past 2 years."
Okay, so well, let's remember to be the inspiration out there, and let's be servants too. Our meeting is adjourned. Those were good.